If you've been to a NARPM event where Justin Anderson has spoken at, then you know exactly who he is. Because every time I go to one of the events that he speaks at, everybody I talk to is like, dude, that Justin Anderson guy blew my mind. And I know exactly why. Justin is super sharp and thinks at another level about real estate investing and property management and business. And for whatever reason, always has like a perfect story to tell a perfect lesson, to illustrate the point that you're trying to make, and delivers it in a great way. And I feel really lucky to have him as a friend. But this episode is all about his book, right? He wrote this book about the golden age of property management, right? Well, really about kind of like these like opportunities in real estate investing that most people are not understanding. And as a property manager, I think this can be your skill weapon. Like knowing this stuff, knowing that it's a really good time to buy and how to explain it, and all these things that we go over right now could make you your client's like smartest advisor kind of thing, right? So I think you're going to love this conversation with Justin. Man, I can't wait for you to hear it. Enjoy. Welcome to the Property Management Frame Breakers podcast. I'm your host, Pablo Gonzalez, and I am here to introduce you to the folks in the property management space that have broken the frame of what you may believe was possible. This podcast is presented by Vendoroo. It is your all-in-one AI solution for resolving your maintenance needs. Let's go. I have been dying to get you on the podcast since Southern States. When we met, everybody was just like, Justin Anderson, this guy Justin Anderson, right? Like, you obviously gave the best presentation there. As I've gone to other events where you have spoken, always the same story. You give the best presentation there, and people are like, man, the golden age of real estate investing. We got a little bit into that conversation, you and I, at Southern States. But I'm really glad that it's happening today. And I'm particularly glad that you're like, hey, dude, read my book before we do this. Because, man, you know, for it's a phenomenal book, right? Like, it's really, really well done. But I haven't sat down and read 200 pages in a day since I was like studying abroad in college, man. So like, just proving to myself that I could do that. But to me, it's a big testament of how you put this thing together. I'm talking about Funny Money for our friend that's listening on the podcast right now. And I would love to, Justin, is like, before we go into like the genius of the book, I like starting with like, punch you in the face. What are we talking about here? And it's clear to me that this book makes an argument for we are headed into a golden age of real estate based on these lenses that you and I will break down. How do you, when people walk away from your keynote believing that they're in the golden age of real estate, what do you think is happening in their head? Like, why are we in the golden age of real estate right now?
First of all, I want to back up and say it's fascinating to me, Pablo, that Southern States Conference was in August of 2024. So like 14, 15 months ago.
Yesterday.
And yet in that last 14 or 15 months, I feel like you've become this really important part of my life that every time we're at conferences and being able to just socially get to know each other in addition to, talking business and your mind and the things that your visionary ideas and the things that you're doing, man, it's an inspiration. I love it. And so thanks
I,
for having me here, by the way.
right back at you, bud. Like, I feel the same exact way. I'm glad you called that out. Yes,
Yeah,
you have become an important part of my life too in a very short amount of time.
it's amazing. And
Yeah.
that's one of the things that's also just cool about the NARPM community, because I think about all of the other friends and connections that we have in common and some that we don't, but just that experience in that community has been outstanding. And so, and I am so thankful to have been able to say some words from the front of the room that inspire other people and get them fired up. And you're hearing some of the echoes of that feedback, which is great, because we are, if I were to deliver one singular message to you and your audience right now, I think the answer is, if you don't own real estate right now, it is the time for you to make your next acquisition. And if you already own it, it is still the very next deal you should be doing is now. And it's because of where we're headed in this market space. I'm a student of markets. As you mentioned, there are a couple lenses that I look at to evaluate where in the markets and what types of investments. But we are at this unique location in the market, with everything lining up for this to be maybe the best investment opportunity for the next 20 years. and it's happening right now live in front of us. And yet so much of the media is focused on all the wrong things. And it's creating this incredible confusion. The media is focused so much on affordability crisis and things that we as investors don't really have the opportunity to control. But what we can control is where our money moves and our capital moves and when to strike, when to put our bait in the water and start reeling in fish, or maybe a better metaphor is to correlate with my book, when to grab our surfboards and start paddling out to catch the next wave.
When you texted me that I was just telling you how impressed I was with these lenses, you're like, I think you're going to be most impressed with this long form surfing metaphor that you put out. Yeah, I agree. I agree. Very appropriate to your book of catching this wave. It's funny, man, because as I read through your book and there's like three lenses plus one, right? For our friend that's listening right now, right? Like you talk about the property life cycle, the neighborhood life cycle, and then the market cycle, and how that comes together to form a real estate investment. And then you add this layer of fiscal policy and money policy. And that was really, really eye-opening. And I kind of want to break it down in reverse fashion. Because once I got
Okay.
to, and you tell me if I'm explaining this correctly, but you essentially, well, actually, I took a picture of you breaking down the cost of a home in relation to the price of gold.
Mm-hmm.
And I sent that to you, but you weren't the only person I sent that to. I also sent it to Greg Cohen of JWB Real Estate Capital about like, dude, we got to make a show about this so we can sell more rental homes for real estate capital. And he was like, I'm in. And then I sent it to my men's accountability group, all real estate investors. And I said, just looking at this makes me want to buy homes. I will let you first kind of like describe to our friend that's listening what that picture was of and like the thinking behind it. Because then I want to insert the idea that they were like, this doesn't make me want to buy a home at all, and we're going to noodle on that. So what is the argument that you make on homes versus the price of gold in the book? We are about to head into, I think, the most interesting part of the book. It might get a little bit heady for you, but stick through it. It's interesting kind of like discussion about gold, and I can't recommend that book enough. But let me tell you one of my favorite things that's happening right now inside of Vendoroo. It is the idea that clients, when they onboard, are going through this like onboarding experience that when they finish, their processes and policies have all gotten stronger. And I don't think people understand how powerful that is, or even that it's really, really happening, because we're not really advertising, so you're first to know. But I think there's this like narrative around, I can't be buying software or implementing something new if my policies and procedures aren't airtight. I got to go there first. And what we're seeing is that in this new world of AI as a teammate, right? Like just think about hiring your best teammate ever, like somebody that came from your biggest competitor and they came with all the knowledge of like processes and policies and all these different things. And as they're doing the job, because they have the experience, every time that they reach something, we're like, oh, we need a better policy here. They tell you. That's exactly what the Vendoroo agents are doing right now as you are onboarding, right? It becomes this perfect mirror and pressure tester of your policies, and people within like 30 to 90 days not only have AI heavily automating a lot of maintenance touch points and giving their team back all this breathing room to do all the things that they wanted to do and actually be able to finish their tasks, but they're also strengthening the operational policies and procedures inside of the company as it's being onboarded. And I want that for you if you don't have it. So if you listen to this podcast, I recommend that, right? Like give Vendoroo a try. Go to vendoroo.ai. Man, things are getting really, really interesting here in the world of AI, and I want you to win in 2026 with this stuff. So go to vendoroo.ai and give this a shot. So
about 15 years ago, I've been investing for almost 30 years. And about 15 years ago, we were in the bottom of a market. It was 2010. We were in an aggressive downturn. And it was a little bit confusing trying to understand what specifically was happening in the real estate world, because pricing had fallen a little bit, but not meaningfully. And at that time, I was really searching, Pablo, to try and understand the difference between price and value, and trying to measure value with something that fluctuates so rapidly, that's so volatile, being the US dollar. It became a challenge. How do I know I'm getting a good price with this asset I'm about to buy? And if we're measuring that asset value in terms of dollars, it can be quite misleading at different periods of time. And I think we're in another one of those times. We are in a space where real estate is relatively at all-time highs. If we think about the last peak of the market, not 2022, but 2007, at that time, the peak real estate median home price hit an all-time high of $257,000 across America. And as we fast forward to 2022, that peak home price hit an all-time high of 440,000, 442 to be specific. If we rewind back to 2007, how many of those homes at $257,000 do you wish you had bought?
In 2007, not a lot of them, no.
But if you now know what happened in history, how many do you wish you had bought?
Oh, right? Yeah. I if they were cash flowing, I would have taken them all.
Yet they looked so expensive and it was complicated. And actually, at the time in 2007, when we actually were able to assess true value, they were quite expensive. So I started looking at a different measure of value. And it came partly from a mentor who helped me understand that if we measure it in something that has a more stable store of value, something like gold, and I acknowledge that it is not an imperfect measure, but it is a more stable store of value than any other asset class that I can evaluate against. So about 15 years ago, I started using this measuring stick of, well, instead of how many dollars does it cost to buy that house, how many ounces of gold does it cost to buy that house? And when we start doing that, we can measure over time to see the relative value of the real estate. Is it high or low? Is it increasing or decreasing? And if we go back in history and we look, go all the way back to 1965, and we can track what the spot price of gold was on any given day in 1965, and we can also see what the price of real estate was at that time. And in 1965, the median home price of a median home in America was $20,200. And at that time, gold was trading around $43 an ounce. And I could talk about why, but I don't want to get off track with that. Gold's trading at $43 an ounce. That made the median home somewhere around 480 ounces of gold. And by the mid 70s, that spiked. It went over 600 ounces, nearing 700 ounces of gold. But by 1980, we got into a space where the median home price had gone to $60,000. It had tripled. It went from 20,000 over a 15-year period to 60,000. But during that period, the US government also took us off the gold standard. And when they did that, the price of gold soared. And if you want, we can dive into all that, why. Just understand that as a fact. You can go fact check it. It's super simple to see this data. The price of gold soared, and we can talk about why. But when it did, by 1980, gold had gone to $560 an ounce. And that made the median home price plummet in value down to around 115 ounces. So we had a situation where pricing tripled, but the real value of real estate, and it was easy to see it now looking back in hindsight, when interest rates were 17%, real estate was trash. Nobody wanted it. You couldn't give your house away. And yet it was trading for 3 times the dollars that it was 15 years before. And yet the value was at an all-time low at that time. It was trading, like I said, from a high near 700 ounces, 10 years earlier to now it was trading near 115 ounces. Fast forward, when I realized that was the case, I started tracking this somewhere around 2010, and I looked from 2007 through the bottom in 2012, sort of tracking it via ounces of gold. And we watched that fluctuation happen. And we watched in 2007 where median homes were trading around 400 ounces of gold. And by 2012, at the absolute bottom of the market, pricing had only collapsed by about 20%, yet value had plummeted in half down to 200 ounces of gold. And that was largely because the government was printing so much money. We were in this massive inflationary mode, and the dollar was weakening so rapidly that the real value of real estate was eroding. So fast forward again from 2012 to 2022, we're sitting in a space where real estate's recovered. Median home price is $442,000. Gold at that time is trading somewhere around $1,800 an ounce. And at that time, I was lecturing and standing in rooms telling investors, not only is the market not going to crash in the same way, because at that time in 2022, we're nearing a peak of a market. The Fed is finally about to announce that they're going to start raising interest rates. All the internet gurus are trying to predict how the market's about to collapse. They all want to be the first one to call it. And they're all trying to base it on past history and looking at, well, in 2007, this is what happened. And we're going to have this massive foreclosure tidal wave. And we're going to have these excess inventory on the market. And all of those indicators were wrong. They were looking at all the wrong things. And the market cycle shows us that. It's the lens, one of the three lenses that you look at. And if we look at that cycle of the market and understand clearly with the indicators what's happening, none of the indicators were the same. There's no doubt we were at a top of a market and we were about to shift and turn, and the market was going to come down, but it was going to come down in a very, very different way. And our government at that time was simultaneously printing so much money, an unprecedented amount of money, that there was very little opportunity for the actual price in dollars to come down. But in value, it started dropping, and it started dropping aggressively in 2022. It hit its last peak, $442,000. Gold's trading around $1,800 an ounce. That translated to roughly 260 ounces of gold to buy that median home. Mm-hmm. And then the government, the amount of money that they printed, which, by the way, I talk about this in the book also, that currency play. Mm-hmm. And most people don't know this. It's a staggering number. But from 2020 to 2022 May, in that 28-month period, whatever it was, our government took us from $4 trillion in M1 currency. So am I okay to get a little bit technical about some of this stuff?
I'm listening to you. I'm able to follow along with it. I'm wondering if we want to take a beat right here, right? Because I have the graphs in the back of my head because I've written them, right? But I kind of want to just give a synopsis of, if we've been talking about this for too long, just kind of like a, let's catch it up for somebody that has ADD like me here, right?
Sure.
Before we get into M1 currency, essentially, if we were to boil down what you just described, this fluctuation of price of gold versus price of homes comes down to a calculation that tells us how many ounces of gold would it take to buy a home. And you've been able to use that over time to estimate the price of homes in gold. And the lower the price of the home in gold ounces, the more value there is to be had, right? Like your core argument is the less ounce of gold that I need to buy a home, the bigger discount I'm getting on this home, because gold, while still has some ups and downs, it definitely retains its value historically pre-World War II, post-World War II, in a better way than the dollar, than the American dollar does. And in lieu of recent circumstances, aka the financial crisis of 2008 and COVID, when we really started, post World War II, we started playing with the dollar. But now in a very short amount of time, comparatively, there's been some real shady stuff done with the dollar, of just like printing and like waving.
Well, hold up. It's
wand.
not shady. It's the
Not
system.
Shady. Not shady.
Yeah, I mean,
correct.
It's not a like conspiracy. The government's trying to screw us.
Yeah.
That is the system. That is how our monetary system is built. But going back to answer your question, yes, I mean, I don't look at, quote, the price of gold. What I'm looking at is value, and I'm using gold as a measure of value. Mm-hmm. And the summary of what I was getting to, cutting sort of the chase, is historically, going back for the last 70 years that we have accurate data, the median home price in ounces of gold has sat around 350 ounces historically over the last 70 years. It's fluctuated. It's been as high as 700. It's been as low as 113 in 1980. Today, it sits under 100 ounces of gold. It's the lowest it's been in over 70 years at this moment in time. And at some point, the value of real estate will come back. It will no longer be trash. And the value of real estate will move back towards that mean of 350 ounces. And that's the premise.
That's the premise. When I sent that screenshot to my friends without all that context, they're like, this makes me want to buy gold. If I can buy homes for such a small amount of gold, why wouldn't I want to buy gold? Can you just kind of like dispel why that's faulty logic?
Yeah, I mean, I don't know that it's faulty logic. I'm not saying that gold is a bad investment. I'm not a gold investor, though. I use it simply as a measure of value. And gold, from my perspective as an investor, gold is not an investment. It is a hedge against inflation. So if I have nowhere better to put my money, my operating capital or my investment capital, if I have no better place to put it to generate a return on investment, and I can outpace inflation or at least hedge against it and maintain the inflation growth, I will park it in gold. And maybe as a portion of your portfolio, you might choose to do that. But it is not an investment in the context that I look at investments. In order for it to be an investment, I want, and the reason I like real estate as an asset class is I'm looking for cash flow, and gold is not cash flow.
Yeah.
I'm looking for a machine that prints money so that regardless of what the government does with money, I have the machine that prints it. And that for me is real estate. So as I own that real estate and the government manipulates the dollars and makes more of them and causes inflation, my machines just start printing more money as that inflationary pressures change. And I'm able to pay down the debt with inflated dollars that make it cheaper.
You and I see the world in very similar lenses in this regard, right? Like my formation as an investor has been largely influenced by my relationship with JWB and doing this Not Your Average Investor show for them and all the stuff. And it's really taught me this idea that I think ING kind of like really crystallized it very well in their ads, right? Like we are raised with what's your number, right? Like you're supposed to save up, save for a certain amount of time until you have this number. And then you can live off of this number, right? And then you can spend, right? The problem with that piece is, and why real estate to me is so attractive, and this point of view of yours of like, hey, what I want is cash flow, right? Like not just a value of something, is that when that happens, right? Like if, like, let's say we save to a certain number and now we get to like draw it down, right? We live off of the interest slash some drawing down of it in such a liquid investment as stocks and, like things that go up and down in value because they're so much easier to sell. Timing starts to really play a role on, are you going to be able to do this thing, right? Like if you have this number in mind, you get to this number, but we're in a recession that year, and that recession, all of a sudden takes 20% off of your net worth that you were going to live off of. Like all of a sudden you're like, oh crap, do I need to work another 3, 5 years? That seems to me like a very unstable thing to count on versus the idea of building up an army of cash flowing rental properties that will, if I have a portfolio of, I don't know, call it 50 homes, maybe I have 3% vacancy rate, 5% vacancy rate. That is way less of an impact on my lifestyle, regardless of like what's going on in the world and what the president is tweeting and like all these different kinds of things, than if the market were to fluctuate. And on top of that, it has all this tax advantage stuff of different ways to like manipulate it, right? So that perspective of investing for cash flow is very, very real to me. And
Can I interject here a
yeah,
little
yeah,
bit
please.
for
Yeah.
just a moment?
Yeah, please.
I've spent the last almost 30 years being involved in and then leading and teaching investment groups.
Mm.
And I want to talk about something you said very briefly, because this is one of the things that I think shuts some people down in this game. And it's this overwhelming idea that they need 50 homes to make this work. And the reality is, the vast majority of investors that I've worked with and my clients inside my brokerage and investors in investment rooms that I've helped coach and grow and lead, it is the very rare individual that has the fortitude and desire to go take on 50 homes. I mean, you got to be a crazy guy like you or me to decide to try and do something. And I don't mean that in any disrespectful way. I mean it to be kind of funny and lighthearted. The reality is, it's not what most people are after. 50 units is a job. And that gets us into a space where real estate is not a passive investment when you own 50 homes. It is a very active investment. So let's go back to, what is the average person really looking for, and why real estate as an asset class and investment class is so valuable and such an incredible opportunity. And to me, it goes back to thinking about what the average rent in whatever area you're going to be investing is, and thinking about when that home is paid off, how many do you need to replace your income at the job you work at? And for most people, the answer is definitely not 50. The answer is a handful.
Yeah, 10 or
And
less.
that's very doable.
Yeah.
That means that the average guy that does, or woman doesn't have to quit their job. They can go slowly buy one house, get it working perfectly, make sure that asset is in good condition and is cash flowing, and that the management company that they're working with, or if they're doing it themselves, which is very doable, that it's manageable. And then we get them to, here's the most amazing thing that happens is when I'm in these investor rooms, the brand new investor that is so concerned about all of the new information they're getting, and they always have these questions that are like, man, but I know there are these rules on how many conventional loans you could get, or I know what happens when I get my 11th deal, or when I have 10 deals, and how am I going to get my 11th one? And my answer to them is similar to the answer to this question that we're talking about here is I've never in my lifetime, after almost 30 years of doing this, I've never in my lifetime meeting thousands of investors. I've never met one of them that ever did their second deal before they did their first deal. And my advice is we should get that first deal done first before we worry about the second one or the 10th one or 11th one or 50th one. Get that first deal done. The most amazing thing happens. Once I've helped these investors get through that first deal, it's almost impossible to stop them from doing a second one. In fact, that's where we really need to put the roadblocks up and slow them down so they don't start doing crazy stuff like I did when I got started. I think that this asset class offers this great opportunity with just a very few handful of assets that folks can become phenomenally wealthy with very few moving parts in an inflation-adjusted asset that is going to grow over time in rents and cash flow as the government continues down this path that is the system of creating and producing more money.
Yes. Thank you for that. Right. Like, I think it's so easy to think I need everybody. You talk about this in your book, right? Everybody starts getting into like a pissing contest over number of homes and how can I scale and how big can I go? And I think it happens in property management too. It's like how many doors under management, right? Like this is just human nature stuff that we get stuck in when in
And caught
reality,
up in.
yeah, 5 to 10 homes in your portfolio will go a super long way towards retirement, along with a little bit of, Social Security and everything else, right? Likewise, you can have a really nice lifestyle with a 300-door property management company. You don't have to build a 10,000-door property management company, right? As I think about what you're saying, Justin, and I'm glad you brought us back to this because I got so excited on the investment side that I almost lost the scent of why this is to me so important to our friend that's listening. And it is, as property managers, there's two things that I want to kind of like test with you. One is fundamentally, I believe that actually, let's go with the simple one first. I think as property
That's good. I like
managers,
simple.
yeah, I think as property managers, you are really well off learning how to sell the idea of holding on to real estate and leveraging it to get more real estate to your clientele, as opposed to selling what your fee is, right? So the idea of like understanding how to talk about these market dynamics and talk your accidental landlords off of a ledge about like how they don't want to move off of their property right now is really, really important. And I want to, and like, or talk to kind of like your existing clients that are real estate investors about, hey, bud, I know you hit the brakes, but like this guy, Justin Anderson, has this really smart thing and maybe you should start ramping up again. Here's a book, right? So I want to touch on that before we get into the idea of us as property managers building a portfolio more deliberately, right? So in the book, there's this gold standard piece that tells you how to talk to an investor about, no, we're not overpriced right now. Just because the price of homes are super high doesn't mean that they're overvalued. You also have a couple of different lenses in there that have to do with property cycle, neighborhood cycle, and market cycle. The property cycle, to start with, is kind of like a peak, and then like the usefulness of the property when it's new is starts to ramp up, and then it reaches a moment where it needs a whole bunch of capital investment in it, and then there's like a whole new use for that property that makes it way more valuable than before. Does that piece happen in residential homes? Like the story is through the theater, right? But is that property cycle piece? Can you talk me through how that applies for the single family asset, or does it?
Sure. So let me give a little context
Yeah.
in the book. We talk about why real estate is on sale right now, despite what pricing says real estate's on sale.
Mhm.
And we can see that through a couple of things, measure of value, but also just looking at the market cycle. That's the broad sort of global look at the real estate market.
Mm-hmm.
Once we understand that, we understand where we're at in the market cycle, understanding where we're at and from a value perspective, and furthermore in the market cycle, understanding where we're headed next. Then the question becomes, okay, so as asset managers, as property managers, how do we advise our clients? Because that's what we are. We are financial advisors for real estate for them. And if we aren't thinking of ourselves that way, we definitely need to realign our thinking. We are no different than the Merrill Lynch financial advisor that advises the client on stocks and bonds. We are the foremost experts in the real estate game in these assets in the client's portfolio. So the question then becomes, what do we advise them? Okay, we can see where we're at in the market. Just go buy houses, go buy any house, just walk out the door and the first one you see that's for sale with a for sale sign in the front yard, should you buy that? And the answer to that question lies in those two other lenses. It lies in the property life cycle and it lies in the neighborhood cycle. And the property cycle, what it defines for us is two different ideas. The first is we should be buying assets in an area of growth and what you would call the path of progress, because there are two components to any individual piece of property's value. And so the first answer to your question is yes, it does exist in single family. Although I used a commercial piece of property to explain this concept in the book, it applies in single family.
Okay.
And in the single family game, a piece of property has two components to its value. It's got the structure value and the land value. And what we want to be buying is in an area where the land value is increasing, that we are in an area that the path of progress, whether that is redevelopment by the city or out on the outskirts of the city where new development is happening, and that land value is increasing over time. Because if it's in the opposite direction, if we're buying a property that's super cheap, cheap does not equal a good deal. Cheap means that property has run all the way out of its life cycle. It is running down to where it's fully depreciated. There's not much life left in that property. And if that land value is also moving in that same direction, it's going to be virtually impossible for you to ever get your money back out of that asset. So just advising clients to go buy cheap assets because they cost few dollars is not the best investment advice. What we should be looking at in the property cycle is when a property is built, the day that it is completed construction, it is at its highest value. And from that moment forward, it does this slow, steady decline, depreciates down till it eventually hits bottom if nobody comes in and does anything with it. At some point through those cycles, though, usually some new family or an investor will come in and purchase that home and take it to a new highest and best use. And if that correlates with progress, growth, new schools, new development, redevelopment, those sorts of things, then we're in an area where they can likely put an improved value into that home and then restart that cycle of depreciation. So just simply following the super guru on the internet that wants you to tell you to go look for that 2% rule or 1% rule or whatever their new fancy, exciting, nobody's ever thought of it before rule, all of that nonsense is driving you towards buying super cheap properties that may be in the wrong cycle, that maybe over time actually have a very negative impact on your overall return on invested capital. So that's the first lens.
Yeah, yeah. And what I'm hearing there, not thank you for reframing that for me, because what I'm really hearing there is that is the investor's lens over the home buyer resident occupant lens. Right? Like as an investor, you're like, yeah, go buy this piece of crap because you can like do all this stuff to it. As an investor, you can increase its value. As a homeowner, you're like, oh no, I wanna buy something that already has this value in it from a property perspective. And what's dangerous is just buying something for the sake of it being cheap and it being crappy and you being able to improve it, as opposed to understanding what the next use for it is going to be in relation to its current use right now. So that really reflames it from me from a single family home perspective. And then I'd love to get into this path of progress conversation with you. I hear that. And we talk a lot about the path of progress on the Natural Average Investor Show, right? Like Jacksonville right now is in the middle of going from being an 8-hour downtown to a 16-hour downtown, right? So
what does that mean?
I'm glad you asked. So the ULI classifies downtowns, the Urban Land Institute, right, as like 8-hour and 16-hour, right? Like an 8-hour downtown is the type of downtown that you just go to work at and then you leave. It turns
Okay.
into a 16-hour downtown once it becomes more of a destination that people go dine at and entertain themselves
Yeah.
at, stay after work, right? And then there's 24-hour downtowns, Miami, New York, right? Like stuff like that. What you find is that for downtowns to turn on like that, you need this like mixed use development stuff, right? Like you need activated streetscapes with people living above it that create a density that drives the flywheel. And under 10,000 residents, that anchor tenant that you need to fund that mixed use development project isn't ready to cut the check yet to make it pencil out. So the city needs to put in incentive dollars. Post 10,000 residents, Whole Foods, Publix, they're in, right? Target's in. So we found this like tipping point of when it tips into an 18 hour into a 16-hour downtown, it's crossing that 10,000 resident threshold, and we've seen it in Nashville and Austin and Denver and Charlotte and stuff like that.
Mhm.
Jacksonville right now is at like 9,000 residents, like the pipeline is in. So we believe that this is going to happen. And then we did all this research around when these cities go from 8 to 16 hours, home prices increase, the home price appreciation increases by an average of 82%, right? So this idea of like now buying single family homes around the downtown before this happens is the path of progress, right? So we talk about this a lot on that show, but I think there's a bunch of other simpler paths of progress too. Of people actually look at, is there a new Publix coming in here, because we know that their real estate department is really good at understanding that they're in the path of progress. Schools, things like that, right? So from your perspective as an investor, what are those data points of like path of progress that you see that are showing that cycle is starting to happen?
So from that perspective, I do want to address the two different ideas of being what you would call a contrarian investor
Mm-hmm.
or a momentum investor.
Mm.
And for the vast majority of the investors that are the clients that we're helping, or the investors that are the investor that's in that investor room that I'm speaking to, and I don't know your audience base necessarily, but
Mm-hmm.
I imagine that your audience base, if it's the property management crowd like me, the client they're speaking to, and
Mm-hmm.
understanding where their customer is,
Yeah.
we should probably not be encouraging those folks to be aggressively contrarian in some moves. Now, in the broader market cycle, being a little contrarian, buying before we hit bottom, before competition comes into play, knowing that the market cycle is going to turn, no problem. Contrarian in the property cycle or neighborhood cycle, one of my professors in my master's program explained it well when he said the contrarian investor in those two cycles is what we would call a pioneer. And you know how you can spot a pioneer?
How's that?
They're the guy that's face down in the mud with the arrows in their back. And so what we don't want to be as a pioneer, we want to be a settler. We want to be the investor that is going in after the pioneers already blazed the trail. They've gone in. We've started to establish that the settlement is going to take foot. And then we can come in, because we only need a handful of these to become wildly successful. We can come in on the momentum move in the property or neighborhood cycle after the momentum has started. So Jacksonville, if what you're saying is that threshold from your data, and I don't know,
Yeah.
if your data point is 10,000 residents and we're at 9,000, we're still in that contrarian move.
Mm.
There would not be a lot of harm in the average investor waiting until we pass that 10,000 threshold, the momentum was in play, even if it meant they had to pay just a little bit more money to buy that asset. We're now in a space where their investment is much more secure than the risk of, well, we got in early, but what happens if it takes another 20 years for it to turn? And I will pick on Augusta, my hometown.
Mm.
Augusta's downtown has gone through three or four since I've been here in the last 28 years in Augusta. It has gone through three or four iterations of getting a little bit of momentum. And this time's going to be the one. This is the one where the entire downtown's going to turn. And is this time? We're going through one right now. There's a little renaissance in downtown going on, a revitalization, this effort that the county is behind it. They're redoing the sidewalks and the streets and putting in new lights and re-landscaping and creating incentives for businesses to come down there. And is this the one that's really going to take off? I don't know. What I want to make sure of as an investment advisor to my clients is yes, we're at the right time in the market cycle. There's no doubt. So if you can find the right deal down there, it may be an opportunity. What I would advise is let's make sure that that deal you're buying, that we're actually buying in a momentum play as opposed to a contrarian play.
I love it. So what is an example of a momentum play for you right now? Like what satisfies that?
I think that it doesn't matter whether it's in a regentrification area in a downtown urban center, or
Mhm.
if it's in a revitalization area where it's a housing product that has been aged over time. I just heard a wind down. Did I just lose the audio?
No, you're good.
Oh, okay. It just sounded for a minute. I got that whoop, 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 whatever noise. If we're in that regentrification mode or the revitalization mode, meaning that the space where a neighborhood has gone through a full depreciation cycle and now most of the homes are tired and aged out, and yet new families are coming in because they're great schools and it's an area where these families that once grew up, and they now want their kids growing up in that area, and they're reinvesting in those homes and starting to turn the wave where they are building those neighborhoods back, putting money into the homes. In
Mhm.
those areas, the thing that I'm looking for is I don't want to be the first guy. I don't want to be the guy that has found that neighborhood. I'm just outside downtown. I'm certain the county's going to come in and they're going to build a new convention center. And I just know that this is going to happen. No, no, no. I want to wait until they're actually building the convention center. And then I
Yeah.
will go down and I might pay a little bit more money for the house I'm going to buy, but my investment is guaranteed.
Yeah.
If I go into a neighborhood that is just prime for revitalization, the housing stock was built in the 60s, and in the 90s families came in and rebuilt it and took it to a new level, and now here we are in the 2020s 30 years later, and I'm just convinced it's about to happen again. I want to actually see that happening. I want to see houses have already been bought low, improved, either resold or families stayed in them after improving them. The yards are starting to look more maintained. The grass is being cut. New flower beds are being planted. New landscaping is going in. New roofs are going on the houses. And I want to see that happening. I don't want to be the first guy in there that I'm running into a neighborhood that's mostly dilapidated, boarded up houses. I joke about it in the book that there was a neighborhood that I had invested in. The way I knew it was time to sell was I got propositioned by a lady
I
of the
remember.
night.
That's right. That's right.
Yeah.
She said, she asked you how much the rent was for, and you're like, well, what? And then she like hiked up her skirt and said, what about now? Is that
Yeah.
real?
That's a real story.
Yeah, I got you.
Yeah.
I got you. So it's obvious. So what you're saying is it passes the eyeball test of like, oh, this is a pretty nice place to live already, kind of thing, right? Like it's
And you
already,
see it
yeah, you
moving,
see it.
and there's
Yeah.
still opportunity, but you actually see evidence of it actually happening. That puts us into the momentum play. For
Mhm.
the average investor, it's a much safer space to be in.
So if I'm a property manager that's listening to this right now, I just want to kind of like cordon this piece off of saying, what I'm listening for is what I can take from this is I can now talk to my clients who are either thinking about selling their home or slowing down on acquisitions. I've got a whole bunch of, at the very least, cocktail party talk to have with them around, did you know that this is happening with gold and the value? Like if I was to take advantage of this, I'd be looking for, right now we look like we're in this market cycle where things are turning up because of these things that we're seeing, and these neighborhoods that we want to improve look like this, right? And I'm in like property management services sales mode. And I would highly, highly recommend buying the book, reading it. Like I said, I read it in one day because the storytelling is really, really good. It's shockingly easy to read for a ADHD guy like me to be able to sit down and crank out 200 pages in one day. I would love to shift this into opportunistic property manager mode because I really believe that, yes, there are some property managers that are building out their company to run it forever and give it to their kids. There's other property managers that are looking to scale and sell. I happen to believe that if I was to build a property management company, I would build the property management piece as a flywheel to feed my investment portfolio. Right? Like I'm much more interested in the idea of building a property management company to like be able to operationalize 40 homes while serving other people and having them kind of cover the costs, and eventually just not really have to. That allows me to really be selective about my clients. It allows me to like sell to other people like, oh no, no, I'm an investor too, so you're using the same contractors I'm using, right? Like I see the golden goose of real estate as off market deals, and I see property managers as the people that farm those geese. And I wonder, when I tell you that, as somebody that has a property management company as well, has a portfolio, you're also a vendor in the ecosystem. What do you think of that? Like, do you think property managers are like, I'm sure you're having this conversation with property managers that are now thinking about it being investors themselves or taking it more seriously, or I'm sure many of them come up to you like, that's what I do, man, because you're obviously the investor guy. How do you see the lay of the land in these conversations that you've been having around property managers growing their own portfolio?
It's a great question. I think, Pablo, that first of all, if we are truly investment advisors, which I believe we are as property managers, and again, that is maybe the most significant mindset shift that I think our industry could use right now, because there are a fair number of property managers I meet that don't invest themselves. And my opinion of that is, if you're advising your clients to invest in real estate, and you are not investing yourself, why should they listen to you? And I don't mean that to be an aggressive black eye, but I kind of do. And I kind of do because there are two benefits to you investing as a property manager. The first is you will create unbelievable wealth. It will meaningfully shift what has to happen for you to meet your freedom goals. And why I say freedom goals, that really is sort of the underlying premise of the whole book. And that is, I didn't get into this business so that I could be the guy that could stand up on stage and boast about working more hours and grinding harder and longer than anybody else. I got into this business because I wanted a vehicle that could create freedom for me to spend more time with my kids and with my family and go on vacation and travel and come down to Orlando to visit my daughter and all of these things. I didn't grow a business so that I could boast about who works the most hours. My property management vehicle is a vehicle that is built to manage my portfolio. And then by default, I started managing for other people as an investment advisor and advising them on building similar portfolios. So I think it serves two purposes. One is very clearly that it creates more wealth with a much lighter lift in your lifetime to be able to have a portfolio of rental homes, and you already have the machine built to run those assets. So plugging those in, but then the second component to it is, again, being able to stand up and offer advice. Your clients are probably more inclined to listen to you if they actually see you taking the advice yourself and getting success with it.
Yeah, I couldn't agree more, obviously. And when I think about this as it continues to grow, it's like the wealth piece makes you more confident, right? Like you don't need the next door to manage as much because you are already building this thing. The I am like you, I eat my own dog food, so you should have some of my dog food makes you more valuable to them,
Or
right?
filet mignon.
or filet, yeah, or filet mignon, correct. Makes you more valuable as an asset to your clientele. And then there's also the idea that I see this as like a flywheel, right? Like I see it as I look at your path and it's like investment portfolio, property management company, and then you can also unlock another service-based company that also feeds this space as well, right? Like the diversification as a business owner of having a real estate portfolio, a service business that services that real estate portfolio and other portfolios like you, and then the ability to then grow other services to continue to diversify and grow in share of wallet for the different components to me is like in this world where technology and all this stuff is creating these like giant players at the top of certain ecosystems that are going to eat up most of it, a la Amazon or Facebook or whatever. Like it is the moat that the small business owner that wants to maintain their quality of life and not be in a race to the bottom their whole career is able to build, right? Like this like diversified set of like companies that produce revenue in different ways, but they're all tied to kind of like a compounding advantage that you build of network and knowledge and feet on the ground of insights and stuff like that. And I feel like you're living that, and it seems like the type of business I would want to build.
Again, I'm going to go back to what I said earlier. We live in this world where everybody is comparing their lives on social media to everybody posting their very best life that is probably not a real depiction of what their life is really like.
Yeah.
And I think at the end of the day, the vast majority of us are all, not all of us, but the vast majority of us are after the same thing, which is having some level of freedom, and freedom to do what we want when we want, to have enough coming in to provide a lifestyle that we desire. And for some people, that's a little bit more. Some people, it's a little bit less. But even in the most like obscene levels, it's generally not more than a handful or two of pieces of real estate. And
Yeah.
by pieces of real estate, I don't mean like giant strip malls either. I mean single family residential houses that are in good school districts. And if they just bought one a year for the next 5 years, it achieves all of their goals. And it might take 15 or 20 years for those to work out, but it achieves all of those goals. And that is why I'm such a proponent of that vehicle, that investment vehicle. The problem that I see is most people get so hung up on this idea of accumulating money and chasing down dollars and trying to boast about who earns the most money and who has the most dollars. And I'll be fair with you, that is, in my opinion, that is an incredibly misguided approach to life. Money is a tool. Money is not wealth. Money is simply a tool. And if we use that tool properly, we have the ability to build machines that we use money to build, and then we use that money to create incentive for other people to work on those machines. So money has two purposes, and I talk about this in the book. Money
Yeah,
has
yeah.
two
I like.
purposes and two
I just
purposes only.
smiled because I recognize this part of it. I really like this. Yeah, go on.
And the two purposes money serves is number one, to create incentive for others to produce wealth for you. So that money is used for me to hire my HVAC technician to go over and fix my air conditioning unit. It's for the handyman to go over and do the work orders. And I am using that money as a tool for that mechanic to go work on that machine and make sure that that machine continues to pump out money so that I can have freedom, so that I can go be in St. Lucia sailing, in the middle of the bay, or that I can go wherever, take a river cruise through Europe, or just come down and visit my daughter for a long, a week or two. And so I'm using it to create incentive. The second purpose of money is to transfer wealth. It is so that when we have one asset that creates money and it's time for us to trade that asset for a different asset, whatever that reason might be. And as an investment advisor, there are times where I advise my clients, it's time for us to consider moving from one asset to another for a variety of reasons. And when we do, I don't have to go find somebody that has an asset that I want and hope they want mine and we trade. I use money as a store of value. So I take the value out of that asset and I sell it and I get money and I hold that money just long enough to go buy the next asset. So it's a transfer of wealth. Outside of that, money has no purpose. And just accumulating it and storing it up and having piles of it, or bragging about who earns the most, what that says to me is you're bragging about who pays the most taxes. I really would rather just see that I have the machines that generate as much as I need. And if I need a little bit more, well, then I go buy one more machine and I start to create a little bit more wealth out of that machine.
I almost don't want to speak because I feel like that's just like the like I want that to breathe. I love how
When we
you,
break it all down, Pablo, and make it
yeah,
that simple, anybody can do this. And I
yeah.
think we get caught up in this world where it's like, well, I need to scale bigger and grind harder, and I need to have 50 doors or 100 doors, or this guru on the internet, or this guy I met, he had 400 houses, or
Yeah.
I'll be fair with you. I don't know that I really want that guy's life.
So much. So what's going through my head as you say this, Justin, is this is the game I want to play. And if I was to think about incentives and store of wealth, it's like for bartering in lieu of bartering, then my goal right now at 45 is to have as little of the store of wealth possible on hand to get me through any kind of like a turn or a bad situation that's going to happen inside of my real estate portfolio or short-term hardship that I may or may not have, while having the rest of my capital completely deployed, creating those incentives for people to continue to build that wealth machine, right? To run that wealth machine.
It's semantics, but I'm going to say it just slightly clearer. It's not storing wealth. It's money is not wealth. So
Yeah.
I need to have enough money, liquidity, to
Yeah.
operate my life and my
Operate.
business.
Yeah.
But beyond that, any money that I have not deployed, think about those dollars like little recruiters. I mean, if I put those recruiters to work and I send them out into the marketplace, and deploy them properly, they're going to go recruit other dollars to come hang out with me.
Yeah.
And that's what I need to do with those dollars. So I need enough of them set aside so I have liquidity to operate my life and my business. But beyond that, I don't need excess amounts of those sitting around. I should be deploying those into some investment. And if I have, going back to the beginning of our conversation, if I have nowhere better to put them, gold is not a terrible solution.
Yeah.
But I do think gold is at a high price right now.
All-time high. Yeah.
So I don't know that I would be deploying my money into gold unless I just had nowhere else to put it. But right now, there are a number of asset classes that we can deploy that capital into that are going to generate a greater return over time than gold will.
That makes sense. I think my follow-up questions are literally just showing you everything that I have and you telling me how much I need to just keep it on cash flow. But I'm in, man. Anything else that I haven't asked you, Justin, or anything that you thought that you would want to share that we haven't gotten into?
I mean, Pablo, I appreciate you taking the time to have me here and read that book. I encourage anybody listening to this to just, if you've liked anything I've said at all, I would tell you, go get that book. I very specifically wrote it in a fashion that is very digestible with funny stories and easy to grasp these reasonably complex ideas. What I would tell you is if you are a property manager that is looking to help your clients, that book can be the tool. That book can be the tool to hand to your client so that you don't necessarily have to explain it perfectly. Give them that book, Funny Money, Building Wealth in a System Rigged to Keep You Broke. Give them that book, and that book will explain it. So then all you have to do is help them find the right asset that matches their needs.
I love it. I would say if you are listening to this right now, buying one of these books per client that you have as a Christmas gift would be a phenomenal investment for your business as a marketing play of showing up as like, here's a gift for you. And equally as importantly, as something that's going to feed your beast, right? Like there's no way you read this book and don't come away thinking, all right, I want to add one more door, a handful of doors to my portfolio in the next 12 months. And I think as property managers, we can do a much better job of evangelizing the asset class, not just fighting to see who is the cheapest fee or whatever we're trying to do. So this book
I would agree with that.
Framework, man.
So the book is available on Amazon. I don't know if I can give you a link to do it, or if you just go Funny Money, Justin Anderson, it comes up on Amazon.
It's true. All you have to do is Funny Money and it comes up. I found it that way, but I will link it in the show notes and all that good stuff, right? So that'll happen. There'll be a call to action that I'll post produce in here, but just know, listener friend that just hung out with us, go buy this thing and use this as a gifting strategy. It's going to do well for you.
And then go buy houses.
and go, man, I would love to become more of a watering hole in the property management community around how to be better real estate investors, period. So I think that's something that you and I are going to have a conversation about here because I know that you do your masterminds and you do these kinds of things. I'm going to a mastermind this week, but like, I really believe that he or she who understands the problem the best will have the best solution. So if our job is to keep people in the real estate investment asset class, we should really understand how to do this ourselves. And I think it's going to be really good. So I see us doing something like that together, Justin. But
I'd love it.
More than anything, man, you kind of took the thunder out of this in the beginning, because I like to end with a compliment like what you gave me to start here. But the reality of, we were sitting at the gastropub and you were giving me advice on something, and you dropped this like whole long story, which by the way is a backstory to a big part of the story in the book, and wrapped it in this like beautiful lesson of what I should do next with something I'm really, really struggling with, all within a story of a super impressive feat. Is kind of like what I've grown to expect from you these days, man. Like you're such a, you just come across as like the guy that, like, I can't help but want to spend time with you, because not only do you have the wisdom and the receipts and all the stuff that you've done, but you also are this like incredibly gifted communicator. And reading this book was one of those moments where I'm just like, kind of like when you told me that story, it's like, Justin, are you like the coolest, smartest, best looking person in every room? Like, reading this book was a moment where I'm like, man, you're not just all these things. You're also a phenomenal writer and a communicator. And we've even, that's one of the things that I most admire, man. So I'm just really, really grateful that we did cross path at Southern States. I'm grateful that this like NARPM conference circuit with like summer camp program has turned us into such good friends, man. I'm such a
Indeed.
fan of Scott, and like watching you and your son like do this thing on the road is something I take great joy in. And thanks for doing this, man. I'm glad we finally did this, and I'm really pumped of like where our friendship is a couple, like just a little bit over a year later and where it's going, man. Thank you for this.
Same. Same. Thank you a lot. I've enjoyed it.